There often comes a time when we stare at piles of receipts and invoices, feeling uncertain about what records we truly need to keep for our business. Managing business documents can feel like a big puzzle. However, understanding how long to hold onto your business expense records is actually simpler than you might think and incredibly important for your peace of mind. Generally, for most business expense records, you should plan to keep them for at least 3 years from the date you filed your original tax return or the due date of your return, whichever is later. This 3-year period is a good general guideline to follow. This 3-year rule comes directly from the Internal Revenue Service's statute of limitations for auditing most tax returns. However, there are some really key exceptions. If you underreported your gross income by more than 25%, the Internal Revenue Service has 6 years to assess additional tax. For employment taxes, like payroll records, the retention period extends to 4 years from the date the tax became due or was paid, whichever is later. And if you filed a fraudulent return or did not file a return at all, the statute of limitations does not expire, meaning the Internal Revenue Service can challenge those years indefinitely. It is also wise to keep records relating to assets, like property or equipment, for as long as you own them, plus the standard 3-year statute of limitations after you dispose of them. Some state and local tax authorities might have their own specific requirements too. To make this process easy for you, establish a consistent system for saving your records. Whether it is a physical filing cabinet or a digital cloud storage solution, having a dedicated place for everything is key. Make sure to capture receipts and other expense documentation as they occur. Many digital tools can help you scan and categorize these items right away. Regularly backing up your digital files will also protect you from unexpected data loss. If you are ever unsure about a specific record, it is often best to consult with a qualified tax professional who can give you personalized advice. It is not just about keeping the numbers, it is about keeping the proof. The Internal Revenue Service loves supporting documentation, so holding onto those original receipts, invoices, and bank statements is crucial. These documents verify the legitimacy of your business deductions. For example, a detailed mileage log is far more valuable than just a total number at the end of the year. Remember, every business expense you deduct reduces your taxable income, and having solid records is your best defense if your deductions are ever questioned. Think of it as having your financial story perfectly documented. By understanding these retention periods and adopting a systematic approach to record keeping, you are not just complying with tax rules. You are building a solid foundation for your business's financial health, simplifying future tax filings, and safeguarding your deductions. This proactive step provides immense peace of mind and frees you up to focus on growing your business without the worry of unorganized paperwork.